In 2020, Spotify famously paid Joe Rogan $100 million to leave YouTube for Spotify. How much is your channel worth? This is a question for the ages. For hundreds of years, people ask how much their business is worth. Malcolm here. I'm an engineer, an investor, and a strategist. I build products for a living, and I'm always seeking out the answer, what is it worth? You're probably spending thousands of hours crafting your channel. Selling it is probably the last thing on your mind as you begin the journey. But you can't escape the inevitable headlines proclaiming the millions of dollars changing hands as podcast and YouTube channels garner stardom. It's probably sensible to understand what and how value is created. You never know when you may need to pull out your trusty spreadsheet. Firstly, it's worth confirming the legal parameters around selling your creator business. Is it allowed in those original terms and conditions you agreed to 5 years ago that you probably never read? The good news is Google does not prohibit this in the YouTube TOCs as far as I can determine. What makes a creator channel valuable, you may ask? Obviously, subscribers are a key asset. How about authority? As a counter to this, recognize that the channel is based on you, and so there is a notion of the key person discount. How well is the channel monetized? How diverse is the stream of cash flows? For personally branded channels, much of the value is tied up in your personal brand, but recognize that the ancillary businesses created is definitely worth something. Enough of the background. Let's pivot to how a business is valued. There are two ways any asset is valued. The first approach is known as pricing. The second, intrinsic value. We are all familiar with pricing. Pricing is about comparing similar assets and pricing them accordingly. The most apparent example is house pricing, which uses the concept of comparatives all the time. Pricing often uses multiples. For example, common parlance in stocks is price-earnings ratio. In the creator space, pure blog plays have purported multiples of 20 to 30 times monthly revenues. Another often bandied number is online businesses selling for 3 times yearly profits. Multiples are often the way a buyer will negotiate a price, often finding suitable comparables to make their case. But what is your business really worth? Strip back the fancy multiple and ask yourself, what is the intrinsic value of a business? It's really quite simple. It comes down to cash flows. Whether you are buying Costco shares or a small online business, you are really buying a share of the future cash flows the business can promise. The word promise needs to also be unraveled because it really translates into what is the risk that I won't receive those cash flows. This is what intrinsic valuation attempts to do. Quantify the cash flows and discount the risk using the concept of time value of money. In other words, the present value of future cash flows. Let's attempt to value a creator channel. We begin by selecting the country you live in or the currency you receive your income. Currency and country of incorporation are relevant because they determine the baseline risk-free rate for your valuation. Remember, we are building up our estimate of risk, of receiving cash flows, and we start with the baseline risk-free rate. That is the rate for the country that has no default risk over the period of your cash flows. pretty standard approach is to use a 10-year time horizon for the risk-free rate, and we will talk about cash flow time horizon shortly. The government risk-free rate may have some default risk which we need to strip out. I automatically do that for you, and for those interested, it's basically based on the country rating from Moody's. Step 1 done. Remember, we are building the risk side first. Next, we layer on the countries you would receive revenue from. Why do you do this, you ask? Well, it's those risky countries and say are in some sort of chaos. Perhaps the number of views will drop. It should be easy to estimate these using your YouTube analytics, and then select a country or perhaps a region and enter a percentage for the number of viewers. The next item is all about your niche. Here you can select the types of topics you are most closely aligned with. The idea here is that, say your niche was entertainment, then you are closely aligned to the risks of that industry. If you like, you can select multiple industries here. Alright, let's move on to this mysterious number, book value of equity. If it sounds like accounting doublespeak, it is. Let's simplify it. Say your channel has existed for 4 years. Estimate how much profit you had left over in each of those years, which is probably the amount of cash you had made, and accumulate this total. This includes any amounts that you've invested or that you took out of the business. Don't worry too much about this accuracy, as it's only used to calculate the risk percentage allocated to debt and equity. If you have any bank loans or credit card debt, total them into the book value of debt. Estimate all your annual interest payments, average out the time period that you need to pay your debt back. Mostly this will be within 1 year. Take your bank balance and any securities into cell 32, which is cash and marketable securities. Okay, boring accounting stuff done. Let's do the imaginative gazing into the crystal ball. For now, we ignore the loose ends around failure, distress, and key persons. Let's remain optimistic. There are 2 sections in yellow: revenue drivers and cash flow forecast. Think of revenue drivers as the inputs for your cash flow. You can make your own inputs and replace my number of videos, number of subscribers, revenue per subscriber with any attributes you like. Basically, you need to get to a base year revenue and then revenue growth rates for all the years looking forward. Base year means the current year we are in. How many years forward should you forecast? Many small businesses can only sell 3 years forward revenues. If your channel is only a year or 2 old, I might stick with 3 or 4 years. If your channel is 3 to 5 years old, maybe you'd be able to sell 5 to 6 years future earnings. Only very mature channels like Rogan would be able to include a terminal year, year 11. Simply use the pull down in the row header and make it 0 to eliminate that year from the cash flows. So now we have discussed revenue and revenue growth. Let's turn our attention to operating margin, taxes, reinvestment, and then we are pretty much done. Operating margin is the percentage of revenues which is profit after you have considered costs like salaries and wages, any expenses to operate the business such as subscriptions, training courses, travel, and the cost of goods sold, and any admin costs for your business. Don't include investments in equipment, depreciation. Taxes are simply your country's marginal tax rate. That is the tax rate in legislation. If you have a lower tax rate currently, you can put that into cell B54 and put the marginal tax rate in O54. I have a table of worldwide tax rates and pull that into cell N54 for your reference. Finally, reinvestment is the yearly amount spent on equipment and any other property, basically capital expenditures, and you can reduce this by any depreciation of these assets. You should probably depreciate equipment, software, etc. over 3 years in a creator type business. Now that you have this year's reinvestment, you can go on to forecast reinvestment for the future years. This is done with the sales to capital ratio, and you can simply guess a number and fine-tune it by watching what actual reinvestment calculates out to. See if that makes sense for each of the future years. Basically, this is a ratio trying to increase the sales to the needed future investment needs. You may have already taken a peek at the value of equity in B81, also replicated in purple in B38. This is the value of the business. A couple of loose ends to fine-tune. Notice the probability of failure in A34, which is 20%. That is the chance that you won't make it as a business for the predicted number of years we forecasted out. We also said that only 20% of the assets will be sellable if we go bang. Finally, we included a key person discount of 20%, including a liquidity discount. Obviously, YouTube channels where you are the brand, this could be much larger. To counter this, we did include your salary in the operating expenses for the entire period. So yes, you are selling the business, but you will also probably need to keep making these videos. A final few words circling back to the layers of risk which we began the video discussing. That is encapsulated in the cost of capital number. This is the amount that we discount the cash flows to get the present value. This is pretty conventional stuff in finance and valuation. However, you will notice that the discount rate is large, almost 20%. Think of this also as the minimum return a buyer would require. Now, have some fun by changing cell B4 from private buyer to public buyer. Notice how the cost of capital is now around 6%, meaning you will receive a bigger payday. This little change explains why mom and pops get replaced by corporate giants throughout the world. The intuition behind this is that private business owners are generally not diversified, holding most of the risk in that business. In reality, people are a little bit more diversified than this. So the answer is somewhere in between. However, the implication is clear. A public company will offer you more for your business. Perhaps a large VC firm is buying up a bunch of channels. Expect them to offer you something right between private and public. As we wrap, remember, this is an intrinsic value, and typically you will actually be paid on a negotiation of a multiple. However, the benefit of intrinsic is you get a real feel for what makes your business valuable. In other words, you can negotiate from a position of strength. Finally, you may be wondering how you can create your own valuation. The first steps is to make a copy of my sheet. Use the bit.ly short URL to open up my sheet. This will be a view-only screen. Then elect File, Make Copy, and just give it a name. Next, check your spreadsheet settings that calculations is set to have iterations on. This is important because valuation spreadsheets have circular dependencies. Finally, you can change your currency to whatever you like. I have a script which will then format each currency cell. You will need to tell Google Sheets you authorize my script. You don't really need this if you simply want to format all the currency cells yourself. Just follow the steps to allow my script to work. Once done, it's easy to use. Just select the currency and format cell E5. Then select Menus, Utilities, Update Currency. This will then format all cells which are currencies with the correct symbol. Thanks for watching, and subscribe to get updates to the valuation sheet.